are you ready to go, Anthony?
Yeah, I don't know if we want to wait for any more people. I think we had 13 or 14 RSVP, or if you want to just go for it.
Yeah, we're recording it, but yeah, I hate making people wait, but yeah, let's give it a few more. Maybe Toby will be off his.
Oh, we can start with this. We can start with maybe some questions from anybody that maybe already has either questions coming in, or maybe knows about this at all, or has no clue, or maybe understanding the level of education would help me kind of present this better too.
Totally. Bista, you want to go first?
I know a little bit about it, but not much.
Okay.
Mhm.
I think, it's just we use as a life insurance, and then we try to just deposit everything and then spend from that account. And then it's like, we will have the death benefit as well as, we can use
Yeah.
that money, as a bank, right?
Yeah, good. I mean, we'll touch on
Our
all that
own
too.
money.
You have a basic understanding. That's good. Okay. Anybody else?
Hello, good night, gentlemen.
By the way,
This is my
this is not Bush Light. This is a coffee. Looks a lot like a Bush Light, but it's a black coffee. But anyhow, so want
okay.
to clear it up out there.
All right. Can you guys hear me? You
Yep.
guys
Yeah,
hear
go
me
ahead,
okay?
Mike. Sure.
Okay, thank you. Yeah, I'm a complete and total novice, so anything that you guys can teach me from literally zero is great.
Okay.
Thank you.
Great.
Cool. Ivan put in the chat. He has
Okay,
no idea.
cool.
So you're gonna.
I think we've heard from
Fire.
Ashley. Can you hear us? Do you have any prior knowledge of this? You know how this stuff works, or are you starting from scratch as well?
I'm starting from scratch as well, complete novice. I do have investment experience, but cash deals, never using somebody else's money to kind of
Okay.
maximize profits and stuff like that. So
Okay,
starting from
great.
scratch.
No, this will be great for everybody then. Okay, cool. All right, I think we can get started. It is recorded. If someone jumps in and joins and has a question, we can ask away or whatever if you want.
Oh yeah. All right. Toby's on with
What's up,
camera.
Toby? All right, so I guess I'll go ahead and start. Basically, these guys, Toby and James, asked me to kind of go over a course here and explain how we can use life insurance to reinvest in real estate. And for me, that's my everyday topic, everyday conversation with every one of my clients. That's what I push using life insurance for. I mean, ultimately, people do die, and we do want to have protection in place. But the way that I use this form of life insurance has very little to do with any death benefit, certainly not in the short term. So in the short term, we're going to use this as a tool to basically leverage it. And what we're going to do is build up some equity on ourselves and reposition that into another cash producing asset, in this case, specifically real estate. And the way that it works is a lot like real estate, which is nice because most of you should understand how real estate works. So we can kind of talk about the similarities between what this product does and how it kind of correlates to real estate. So that being said, if I explain how what the two different life insurance types are, this will make more sense. So forgive me for kind of backtracking a little bit, but there's term life insurance and there's whole life insurance. And just like real estate, there's renting and owning. So a term policy is going to be like renting your life insurance. It's a 20-year term, and by definitions, terms expire, except in, Congress and, politics, they don't really expire, but, a term is going to expire. It's a very inexpensive product. For most of us on this phone call, roughly $50 a month for $1 million of coverage. Okay. And all that does is provide a death benefit. So you're basically placing a bet with the insurance company that you're going to die, and they're placing a bet that you're going to live outside your 20 years. So it's just short-term protection. It's 20 years. Typically, it could be 10 years, it could be 30 years, but typically a 20-year term. And all it does is it's like car insurance. It only pays out if you crash. Term insurance only pays if you pass away. There's no other value to it. But the main value is protection. It's inexpensive, but it's like renting a house for 20 years. After you move out, there's nothing to show for it. Okay. Switching gears to whole life, that's like owning a house. And just like, as you own your house, your property, as you pay it down, you get more equity. Your equity increases the longer you have it, the more you pay into it. And just like you don't have to wait to sell your home or to pay off your home, to use the equity in your home, you don't have to wait to die to use the equity on your policy. Same concept. You can access the home and your equity in your home by doing either a HELOC or a cash out refi. Refinance, you can cash access the equity in your home while you still live in it and long before it's paid off. Same concept with your life insurance plan. You can access the cash in your policy long before you've passed away and long before you even, have paid into it for a very long time. So there's ways to capture the equity much sooner. And I'm going to show you guys with some charts on that too. So same kind of concept. The longer you own the home, the more the value goes up typically, and the more the debt's been paid down. The longer you have your policy, the same thing. The more you pay into it and the longer you have it, the more the equity grows. And it's all exponential too. So kind of like the amortization schedule of a mortgage, in the beginning, a lot of your mortgage payments going towards interest and taxes and insurance and all other shit that's not actually paying down the debt. Same kind of concept with life insurance. In the beginning, a lot of that payment is going towards your death benefit. And as time goes on, more and more goes towards your cash value. And that, liquidity chart almost is like a Nike check mark where it kind of goes down a little bit and then it goes up forever. Okay, so I'm going to show you guys on how we can shorten that, I guess, negative equity part of the life insurance policy and how we can speed up the availability of cash by how I structure my plans. So all that I will touch on. But so far, is that making sense to everybody, or is that anybody want me to go over anything else again before I move on?
No, I've never heard it explained like that, and it's brilliant.
Okay,
That's great, man.
good. All right,
What
so-
is, like, I have a quick question. What
Sure.
is like a return of premium policy?
Similar concept, and that's a great question. So I'll have to backtrack a little bit to fully answer that. So life insurance as an investment, dollar for dollar, is pretty shitty to basically be frank about it. There's a few different ways to structure it and certain companies to use that make it good. Okay. So if you look at Dave Ramsey, he kind of, shits on whole life, right? He hates it. And he's like, oh, buy term, invest the rest, right? What he's saying is not completely untrue. What he's referring to is most insurance companies only have return of premium, which is your guaranteed 4% return. As the longer you have it, the more they pay you back, and you basically break even by the time you pass away. That's what he's referring to, return of premium. So as you pay into this thing, what you've paid into it after a certain amount of time, it kind of reverses and starts kind of giving you some cash back. That's not what we're going to use. That's 99% of companies only have that. In order for this to work, we have to work with a company that has a strong dividend. That dividend is the difference maker, essentially, because that dividend, like any dividend, it's kind of a bonus paid back to you. That dividend is going to be on top of that 4% return, which is guaranteed by the government. The dividend's kind of the bonus on top of that actually makes this thing work. And that'll be in the columns I show you guys. So back to what he says is, buy term, invest the rest, and whole life's never a good investment. Except if you use it for the right companies. And there's about 5 companies that do this really well. I start all my clients with Penn Mutual. And if for some reason someone gets declined or there's silly reasons, maybe 1% of my clients will use a different company, but there's, Penn Mutual, Northwestern Mutual, New York Life, Mass Mutual, and Guardian are kind of the big 5 companies that have a strong dividend that this plan can work for. So that's kind of a long-winded answer to your question, but I mean, most policies don't have a dividend, certainly not a strong one. And they rely on that return of premium, and it's kind of a shitty plan overall, if that makes sense.
I have
Okay,
one quick
looks like-
question.
Yeah, we're gonna have to talk after. Sorry.
Sure. And to that last comment there about talking afterwards, like if anybody already has a whole life policy, I'm happy to look at that. And certainly after this call, you're gonna see why. It's the company is part of it. The way it's structured is even more important. And that's definitely part of my talk here, because again, this doesn't work unless we structure it properly or we have a good company. Without it, this won't work. So sounds like you may already have a policy. That's great. We'll look at it. And just like if you have equity in a home, you can 1031 that equity to another property without paying taxes. With life insurance, it's a similar concept. It's called 1035. Roll the equity over from an existing plan, even if it's performing shitty, there's typically some kind of equity in there. Roll it over to a new one and it performs, excellent. So Yeah, I got a question on there about how getting the recording. I can email that to James and you can pass it out if you want, James.
Yeah, and I'm recording and
Okay,
we'll,
cool.
we'll post it on our website.
All right, great. I might have to bleep out all the curse words. I'm not used to censoring, so.
No worries. Let's leave
Besides
it.
that, any other questions about, any other questions at all before I kind of jump into
Yes.
how this works?
Yes, one quick question.
Sure.
Do, you may cover this during the course of this, I'm not sure, but
Sure.
it just came to mind. Is there any difference in terms of how we would use a term life policy versus a whole life policy to get equity towards a real estate or even a business deal?
It's pretty simple because term life, you can't use it.
You
Only thing you
can't.
do with term life is you can die or you can outlive your term. That's it.
Is there an
There's
easy
no
way?
equity. Now, with that being said, there's a third thing you can do. I do a lot of my clients will start with a term policy. A lot of my younger clients who have not much disposable income, we can convert term to whole life, but nothing happens with term life until you convert it to a whole life, until you die or until it expires.
Okay,
Does that
thank
make
you.
sense? Okay.
Yes, thank you.
Anthony,
Yeah.
what percentage of term life actually ever pays out?
Oh, it's minimal. It's like 1%, 2%. I mean, the insurance companies do a good job of underwriting people.
Mhm.
You know, they're looking at again. I said earlier as it kind of in jest, but they're making a bet and you're making a bet, and they're not going to place that bet if it's a losing bet. So
Yeah.
Or if it is, it's going to be expensive for you, right? So a lot of term plans, they're 20 years. People get them when they're young. It's very important to get it, but most plans don't pay out. People outlive their term, and if people that listen to Dave Ramsey don't get whole life and then they expire and they're 40 years old, 50 years old, and they rely on their assets to pay off stuff. It's a mess. We can talk on that one-on-one, but yeah, whole life is where you want to be because it doesn't expire and those do pay out.
There's a reason why actuaries are paid a lot of money.
Yeah, exactly.
They've got this all
I
figured
can
out.
turn it into a whole, shitting on Dave Ramsey episode too, if you want to, because I think what he does is he misleads people terribly. And that's for another episode, I guess. But
Yeah.
the main thing is like term is very important. I don't want to discredit the value of term life insurance, but provides no benefit if you don't die. Okay, it's protection for your family is the way you want to look at that. That's it. That's our
So
very
Anthony, if I start a whole life policy today,
Yep.
how soon can I use it for an investment?
Great. So I'm going to talk about that. The short answer is roughly 30 days. Depends how we structure it.
Okay.
Okay. Depends how we structure it. And I'll make sure that's crystal clear. Provided I guess that's from the day you get issued, right? If we wanted to start the process today, you might take 2 weeks to go through underwriting. You might take 24 hours, right? But from the day you get issued and the money's in the account, let's call it 30 days before you can pull that money out.
Okay, but I can only pull out what I've already put in.
Correct. A version of that, and I'll make that clear when we get to the slides.
Okay, thanks.
Anybody else? All right, cool. I'm going to share my screen and kind of go into a couple different policies, and I'm going to start pretty much with the worst and go. I got 3 different scenarios to show you guys. One thing I want to be clear about too, I've touched on already a little bit, is how we structure the policy is very important. And when I show you the numbers, you're going to be like, why would anybody not get this, right? And the way these are structured, it's all commission based. Okay, I don't charge a fee for talking to people, for consultations, for anything. I get paid on what goes towards life insurance, and that's it. So when you see these numbers, some of this money is going to be, I'm going to show you a scenario where all the money goes towards life insurance. It takes a lot longer to develop. It does develop, but it's not ideal for what we're doing. I'll show you another scenario that's kind of a mix in between, and then a scenario where a lot more money is going towards your cash value. You guys are going to see the differences. But the short answer, because I know the question will probably come, it's like, why would anybody do that? It's commission. And most people that do what I do don't even talk about what's called overfunding. And it's the first time I've used that term, I think, today, but overfunding is the key to making these things work for investment purposes. So if you don't overfund it, or if you have a policy and you're not sure if it's overfunded, it's not overfunded. And the reason it wasn't overfunded is because your insurance agent was looking out for him and not for you. So, and I can show that with math, and I'll argue with anybody pretty good at that. There's no mathematical reason why you wouldn't get an overfunded life insurance policy. So that being said, we're going to jump into some graphs here. Let's see if I can share my screen. Okay, so what is this? Okay, that's the wrong one. There we go. Okay, so what I'm going to show you guys is a 30-year-old male, best health, doing $1,000 a month in whole life, no overfunding, just strictly paying for life insurance. Okay, and what this is going to show you is, and I'll use this slide probably just to show you how the money breaks down, and then when you guys see it done differently, you'll see the big difference and how it performs better. So, okay, let me get my crayons out here. Okay, so what this is showing is $1,000 a month, 30 years old, and the initial death benefit to start this is $1 million, and a little more than $1 million. So what happens with whole life is this is our death benefit always starts here, or pick a number wherever it starts, and it grows forever. Okay, and what you're essentially capturing in your cash value is the difference from where this death benefit starts and where it ends. So getting back to, and this is a little bit different layout than I'm used to, but I'll clear my drawings. So for this guy, this is where no money's going towards your cash value. It's all going towards insurance. So this right here shows us 12 grand a year. That part never goes up, which is a good thing. And that's going to be for all three policies. You're going to see this is the same amount of money forever. Now, as you guys understand, like a 30-year mortgage, with inflation, this will get easier. Over time, 20 years from now, 12 grand a year is not going to feel the same as it does today. So in theory, it gets cheaper. In actuality, it stays the same amount of money. I guess in relativity, it gets cheaper, and in actual, it doesn't decrease or increase. But that's going to be everyone's policy any way we structure it. But right here is going to be the big difference between, this is how most people structure it, and then the way I'll show you the next one next. So I talked about a dividend earlier, right? The dividend is what's going to drive this thing to perform and actually be worthwhile. So without overfunding it, you see there's no dividend for the first 4 years. So that's going to set us back quite a bit. But eventually this dividend does take off, and this compounds forever. It does get pretty substantial, but in the beginning it's really slow. Time is money. So compounding this from zero is hard to get ahead of. But this isn't the worst scenario. This is a good company, just structured poorly. So it's, halfway there, but still not the best we can do. These next columns are going to show you how much money you put into it to date. So, annual premium, 12 grand doesn't go up. This is adding it together. So in this scenario, after 2 years, you've put 24 grand in and you have no cash, right? So to answer, the other question was how soon can I pull the money out? Well, in this case, it takes you 2 years. That's pretty shitty. I don't like that. And the death benefit itself isn't even growing for the first 4 years. Again, pretty not great. But this is how they're all going to work in a sense. And we're going to speed all this up and make this much more valuable in the short term. So one number I want to highlight just to show you guys, the math side of things is, let's pick at age 60. And at age 60, the cash value is 686 and 1.63 million. Okay. And the cumulative premiums 360. So remember these three numbers. I'll put James in charge of that. I'm going to clear these, and we're going to show you a policy that's done a lot better, but still not even the best. So let me move my thing here. Okay. This is going to be same person, same age, same health, and same dollar amount out of pocket every month. Every month. But the difference is, instead of putting the full $1,000 towards insurance, what we've done is put $500 towards insurance and $500 towards overfunding. The only negative to that is the initial death benefit is smaller. I've got ways to fix that too, which is add a small term policy for $20 a month, we'll bump that up to over $1 million, no problem. So same amount of money out of your pocket. Now, going into the actual structure of the policy, how does it perform? Well, in this case, we can see immediately we've got a dividend, still pretty small, but something, which is compounding now, right? Off of something which is moving faster. And our cash value is also much more available, much quicker. So you've got, again, 12 grand invested the first year, access to almost half. The first 2 years are pretty slow, no matter how we do it. But it does start jumping after that. You've started narrowing this gap. And in this case, we break even between years 9 and 10. The other one I forgot to point out, but it was year 13, I believe. So we break even faster. Now, the death benefit is still growing, just like the other one was. And if we go to retirement age, 65, was it 60 or 65? I can't remember. James?
60.
60. Okay. So I believe we were at 600 something thousand, right? We're at 725. And the death benefit was 1.6 and we're at 1.5. So we're just a little bit shy on death benefit. Right? Couple years that will pass it. I think age 65 and it'll certainly pass it. So mathematically, there's no real reason why you wouldn't want to overfund it the way we just did. Again, this is in this scenario, the commission's literally cut in half by doing it this way. And the beauty of this is if we got into a jam or got into a hardship of any kind, the overfunding portion is optional. So this 12 grand a year could be 6,000 a year if we needed it to be. Okay, but the instant liquidity right here is the big bonus, and then the long-term performance is much better. Now, again, this is, I don't know if these are small numbers or big numbers for people. This is relative. This is not going to get you into real estate all that quickly, but let's just stick with this for a moment and say, this is all we got. And this is, I have a lot of younger clients who don't have a lot going on financially, but in the midterm, this puts them in a good position, right? So a lot of my clients may start with something like this and all they have is $1,000 a month. They don't have a big lump sum to throw into it. So what I show them is these first 10 years, pretty vital into the performance of this plan. So long-term, they're going to be good. Death benefit's going to cover them and their family. Overall, they're going to have plenty of money. But the first 10 years, how do we make this work? Okay. Well, in the first, 10 years, I guess 9 years, you're upside down technically on the money you have available versus what you've put into it. But the beauty and kind of the magic of this whole thing is, let's use 30 grand as a down payment number. Every 30 grand in here, roughly, we can take out and buy some rental property, right? This is maybe not quite 30 grand, but by the end of this thing, you have 4 $30,000 down payments, roughly. What happens is, let's say we break even, but now we've got 4 pieces of rental property that are appreciating. They are cash flowing, ideally, paying back your policy. And one of the other things about this thing is this money over here never leaves your account. So when you take the money out and put it in real estate, it's still technically in this policy, because what we actually get is, I'm going to kind of draw some lines here. This money never leaves your account. What you get instead is a line of credit against the cash value. So you get to borrow the cash value without removing the cash from the policy. So what that does, it does 2 things for us. And forgive me if someone's asking questions, I can't see it. I just hear them popping up, but I can jump to them in a minute. But what that does is 2 things for us. We get to access this money tax-free because it's a loan. All loans are tax-free, just like in real estate when you borrow against your property. And this continues to grow inside your policy, whether you borrow from it or not. So for easy numbers, if you have $105,000 in here and you borrowed out, let's say 50K, you'd receive a dividend on 105 and you'd receive an interest charge on 50, right? So it's an arbitrage. You're always receiving a dividend on this money, no matter what happens. Does that make sense for everybody so far? Any questions at this point?
All good. Thank you.
Okay, so this is how this could work for somebody. Let's say you guys have a younger client, or even yourself, who just want to get things going. I mean, the best time to plant a tree was 20 years ago. Second best time is today, right?
What's up, guys? I know you're enjoying the podcast, but I want to pause this. I want to bring some attention to my sponsors, Telso Tequila. I want to go over a few cool little facts with these guys. So they are from Las Vegas, and there's thousands of tequilas in the world. Telson is one out of only 40 tequila brands that owns their own distillery. So it's super unique. It's a big flex, right? It's really fucking cool. So based out of Las Vegas, super rad. Check them out. Use our discount code FINAD20, TelsonTequila.com.
Right. So this can be something that is in the not too distant future. You know, if in this case, you know, you have 4 houses after 10 years that maybe you wouldn't otherwise have. Or if you just took it out of your cash and savings, you're replenishing your savings. Whereas here, this cash is continuing to compound and grow forever and provide a death benefit, you know, some tax savings, lots of other things we can get into. But as far as focusing on the real estate aspect, imagine breaking even with 4 pieces of property that are cash flowing and appreciating. You guys understand how leverage works? I mean, you take this, this is my like big Dave Ramsey buster right here. So I'm going to get some white blank spot maybe somewhere and draw it out. Here. So the real estate, I'm not trying to sell real estate. You guys already get that real estate's great, but like the simple Dave Ramsey buster here is he likes to use, you know, a stock market investor at, you know, put 50K in the stock market and you get a 10% return, you've made $5,000. So you have 55K, right? That's pretty good. And 10% return, I think everybody would be happy with. Okay. Take that same 50K as a down payment on a rental, you know, piece of property worth 500K. Okay. You get 10% down, 500K. Well, now that house goes up 10% and now it's worth what? 550, right? So you just basically leveraged and you captured, instead of 5K, you captured 50K by leveraging real estate. So same percentage, 10%, right? So leveraging into real estate, you're going to outperform any stock market investment, in my opinion. Not official financial advice, don't sue me. But what I'm getting at is you're going to outrun any stock market S&P 500 account by doing this. And the tool to get into this is life insurance, because if you were to, let's go back to the numbers here. Let's say you put this in the stock market, and then every time you wanted to take money out and go put as a down payment, well, that account is gone. Now it's got to start over, start compounding again to get back up to 30 grand, right? So you're just taking from a pile of money that's continuing to grow, whether you use it or not. So this dollar for dollar will be hard to match a stock market account. In fact, it probably never will, right? But if you leverage it and you use the fact that it grows tax-free and it's going to compound no whether you use it or not, now you've got kind of a tool that can't be beat. And one thing I haven't touched on is that this is going to grow no matter what, because this is not tied to the stock market. This is based on the dividend and dividend only. So when stock market's up 20%, this kind of looks like shit. But when the stock market's down 20%, this looks pretty good. Or kind of a little off topic from real estate, but let's say you have all your other retirement accounts that are stock market based. This would be a good add-on, because come retirement, maybe you had some good safe money that's not tied to the stock market. And if you're 65 years old and you've got close to $1 million in cash and the rest of your assets are down 20%, well, you could pull from this for a year or two, let your stock market rebound, and then continue on like nothing happened, right? So this is kind of a multi-tool. It's not just investing in real estate, but you know, having some money at the end of retirement or beginning of retirement, whatever, is pretty useful tool. And then also, not to forget, if you've been leveraging this amount of money in the real estate your whole life, I mean, what's your net worth at that point? It's a lot more than what this is showing, right? So hopefully that makes sense so far. And now I'm going to show you guys kind of the optimized plan for real estate. Unless anybody has any questions so far.
So
All right.
how do they charge the interest rate?
Okay, so the loan rate on the money you borrow from yourself, is that what you're asking?
Yeah.
Okay.
Mhm.
So that right now is, the dividend right now is 5.75, I believe. And the loan rate's 5.7. So it's typically right at or right below the dividend rate. It does fluctuate a little bit, but it's pretty close. It's cheaper than any market out there, any bank out there.
Okay. So basically, we won't receive any dividends, right? If we borrow.
Yeah, you're gonna receive a dividend on the money you borrowed, whether you borrow from it or not, right? So even if you borrow all your money out of your account, you're still going to receive a dividend on it, which is going to continue to make it grow. And if you never pay it back, and there's ways to illustrate that too, is if you never pay that money back, one, it just when the death benefit, I'll get to that part in a moment. I forgot to touch on that, but the growth will outpace the interest charge. So you don't really ever have to pay this back. So I can kind of get into that. I'll make a point of that here in the next slide.
Okay.
As far as a loan payback. Okay, so in this case, I'm gonna show you guys a little bit different numbers. This is gonna be a scenario where we're doing $2,000 a month. It's a little bit more than $2,000 a month, but we also put a big lump sum of 70 grand in the beginning. Okay, so big lump sum, and then we're doing 1,000 a month towards your premium and another 1,000 a month towards your overfunding. So we pretty much doubled the last policy and added an extra big lump sum of cash in the beginning. Okay, and this is almost infinitely flexible, but it's a scenario I kind of came up with. So going back to that same chart, I just want to show you guys what the breakdown was of where the dollars were going. So same chart we're looking at, you guys can see that the first year's premium is a lot higher. Every year after that, we say at 26, like I said, it's a little bit more than $2,000 a month. It stays the same forever. Okay, it doesn't go up. Now, death benefit starts out higher, obviously, because we're putting more money towards insurance. And the overfunding, we haven't talked about that yet, but technically what you're doing with overfunding is buying basically paid up additions, what's called PUAs. And that's just blocks of insurance that's fully paid for. So that does increase your death benefit, long story short. But okay, let's go into these columns now, how this actually performs. So initially you've got 84 in and 64 available. So going back to that question earlier, how soon can I take this money out? In this case, and actually this could be better numbers if we paid monthly. This is at the end of the first year. So let's say you put that 64 grand or 70 grand in day one, paid your first month payment. At that point, you'd only have, 62 or whatever, 65 grand invested, and you have 64 available. So on a monthly basis, you have pretty much all your money available immediately. After that first year, though, that money does go towards, insurance or whatever. So like, depending on how we do it monthly, we'd have a lot of the money available right away. Now, the benefit to doing it this way is, yeah, you might lose a little bit of your liquidity versus just taking cash out of your account. But as we talked about in the last one, as soon as you take this money out of your account, it's continuing to grow. Even if you take the money out. If you take it out of a savings account, it's just it's gone forever, right? But once you put it in your account, it sits there and grows forever. Okay. And not to mention death benefit, which again, this is kind of a, afterthought for this use. But eventually that's going to mean something to somebody, right? But in the beginning, as you can see, we have a lot more cash available here. This is some real investment money. And we break even a lot faster by structuring this way. We break even, almost year 7, but year 8, we're breaking even. So once you break even, now you're on the other side of it, and now you're exponentially growing away from it, and you're going to have more money, than you ever put in. So that's kind of how we can structure these to make them better. Hopefully those answer some questions. But to the loan part and the death benefit, let's touch on that for a moment. Let's say you have 307 grand available and you burn through all that cash and something happens, you pass away. What would happen is this 307 would be deducted from this 2.8 and your family would receive the 2.5 death benefit. So essentially, you're always going to have at least this as a death benefit, and whatever growth comes out and you use it would come off of that. Similarly, if in retirement, if you wanted to use this as income, and you get to a spot where you've burned through all your money, you have $9 million here at 90 years old, and you burn through all that because you're living on it, that's fine. Well, your family still receives the difference, and still receives 1.1 death benefit. So that answers how that would pay out. And again, as far as the payback of these loans, it's not structured like anything else you guys are maybe used to. It's basically up to you how you pay it back. and you could never pay it back. No one's ever gonna knock on your door and say, hey, you owe us some money. It's, you pay it back to yourself or you don't. What I like to do is use this, this money. If you go out and buy an asset, well, that asset, hopefully it's a house or a business or something, should produce some cash, and that cash goes back into the policy. Right. So if you just burn through this money on silly stuff, well, it's going to be hard to make that up. But if you buy the right assets, this cash producing asset should pay that back and kind of get to a point where eventually it's just this self-serving ecosystem that's just buying assets, paying itself back, and you're doing pretty good. I can open it up for questions now, or might spark some more stuff here, but hopefully I answer some questions now.
Yes, thank you for that, Anthony.
Mhm.
Quick question. This entire process of building cash value and borrowing against it,
Yeah.
is that something that can be done through, let's say, a typical employer-sponsored life insurance policy, or is this something that is totally an individual policy thing?
Both. So there's ways that your employer could basically pay you or give you compensation in life insurance. There's several famous cases out there. I mean, like Jim Harbaugh was a coach of the University of Michigan. He received, I think, $5 million a year in life insurance versus cash. So there's ways your employer can do this for you. But as far as your typical group plan that everybody gets for working somewhere, that's not going to be the case. This would be what's called a key man policy or split dollar. There's ways it can be done, certainly, but it's not usually done on accident or without some consideration.
Thank you. Thank you.
But if you're like self-employed or you want to do this for yourself, you can absolutely do it for yourself or do it for your employees. If you guys are small business owners, this is great for what we call key man policy. It's great for retention. You could put a policy on your key employee that if he were to pass away, he might be in a jam, and use that to entice him to stay. Like maybe you pay into this thing for 10 years, and then here, man, I've given this to you for sticking around for 10 years. Or if he leaves, then you keep it, right? Or if he passes away on the job or at all, and it puts your company in a hard spot, you've got a death benefit that can help your business out, right? So, man, there's so many ways to use life insurance. I'm trying to stay on topic for this one, but man, there's a lot of ways we can use this for anybody and for children too. Instead of a college fund, you do this for your kids, and they can grow up to have 6 figures of cash. Depends how we structure how young they are. And now they can use that money for college, or they can use it to go start their own real estate empire, start a business. They don't have to use it for college. And if they grow up to be unhealthy, you got them a policy when they were young and healthy, and they have that for the rest of their lives. So a lot of cool things we can do, man. It's not always about death, and rarely is,
Thank you for this education, because I had only heard of it as being used for death. So
Yeah.
you're opening my eyes to a whole lot
Great.
of opportunities. Thank you.
Of course. Yeah. Thank you. Anybody else?
Been over the years, like investors have figured out how
Yeah.
to do this, and the insurance companies have kind of built this so that it can be used, or at least they've let that.
To a point. I mean, it's not that new. I mean, the Rockefellers and the Carnegies were doing it, and they actually had to put limits in place
Right.
because they were shoving like millions of dollars to these policies and then having like a $10,000 death benefit just to use it as a tax shelter. So there are limits in place to that, but like that kind of goes back and say, yeah, this thing's been around. Look at the Rockefeller waterfall trust, right? I mean, that's how the wealth continues on generation to generation. And the tax savings is the biggest thing. All this money grows tax-free. It's paid out tax-free. Some people have large estates. Like, oh man, I'm good. I got 30 million to pass on to my kid. Well, the estate tax takes half of it, or there's litigation or there's other things that come up. This is a nice injection, day after you pass away or whatever, quickly, that you can fight that. So there's a lot of neat things, man. And it's not just death, not just real estate, but real estate, it's huge. It's quite literally becoming your own bank, especially if you're doing flips. You can be using this instead of a hard money lender. Now, granted, overnight, it's hard to make this work day one, but pretty quickly we can make this thing work. And as time goes on, maybe it takes you a couple of years, but in a couple of projects, but eventually you don't have to go for hard money lenders anymore, so a lot of cool things we can do with it.
That's cool.
I have
The different
Yeah.
scenarios and how you can accelerate that. That was really.
Yeah, yeah. But again, most people won't talk about that because there's no commission in overfunding, right? You come to me and say, I got $2,000 a month. You know, it's easy to put all towards insurance. It's like, oh, cool, man. Don't die, but good luck getting your cash for a couple of years. But whereas I just see that as an opportunity for me to fix other people's bad policies and do the right thing, you know.
Yeah.
Also,
Thank you.
like,
I have one more question, if I may.
sure, go ahead.
Now I've had life insurance probably going on close to, I guess, 26 years, more than
Okay.
one policy. As I'm hearing this now, I'm realizing some of the deficiencies perhaps of my current policy. And if I were to try to transfer it over, convert it like you started to mention at the beginning, how transferable is, let's say, my 26-year history or 20 some odd year history in terms of either bringing down the cost because I'm close to 50, bringing down
Yeah.
the cost that I need to pay starting out, and or starting me out with some kind of a cash benefit?
Yeah. So great question. Part of it is, it is what it is, right? If you're healthy, there should be no reason we can't get you life insurance. Okay.
Yes.
You're not going to get it at the rate you got it 26 years ago, but do you know if you have term or if you have whole life or what you currently do have?
I have term. I was led to believe when I signed up for it that it was whole life. This term policy replaced the whole life policy, and this one
Got
I
it.
got at 32.
Okay. So let's just assume it's just a term policy. Okay. Um, if it's just a term policy and the death benefit, you're happy with the death benefit, you're happy with the terms on it, I'd say just leave it alone. What I would do then is maybe add something now to it in whole life version of it. But if it's a decent policy and man, I can look at that for sure. But I can look at the cost difference from starting a new term versus leaving what you have in place. But if you got it 26 years ago or however long, it's probably close to expiring. So what we'd want to do is get a term policy with Penn and then have the ability to convert it to permanent. Or, I mean, if it's with a decent company, maybe they have it as where they can convert it there as whole life, and that might be your best option, right? I mean, it doesn't help me, but I tell you, if that's the best option for you, I'll let you know. Lots to look
Thank
at
you.
for sure, but I mean, it's hard without really looking at the policy.
Right. Thank you.
Yeah.
Thank you.
This kind of goes back to like the whole Dave Ramsey thing, right? Like, I don't like what he says, but he's also not completely wrong because a lot of insurance agents are kind of shitty and they take advantage of people or they don't give them the right policy or they don't structure it right. So it doesn't make sense to invest, right? So it's like, he's not completely wrong, but he's kind of lumping me into that category and I don't like that. So.
Hey, Anthony, do you want to speak about the asset protection of having the
Who remembers OJ Simpson? Depending on your age, you may remember him for different things, right?
Yeah.
So
Yes.
the older crowd might remember him from playing football and then maybe or maybe not, murdering some people. And then beyond that, maybe robbing a hotel room, right? Depends on how old you are, what he did, right? Long story short, whatever you believe happened, he was found not guilty, but then he was found, that was criminally, but then civilly, they sued him, right? What they didn't get was life insurance policy because he had that set up from the Buffalo Bills and the NFL when he was playing. And so to this day, he has money. He's running around Vegas to this day with money because of this policy. So when it comes to asset protection and lawsuit litigation, a whole life policy is bulletproof. They cannot touch it no matter what. And I use OJ because I believe that's a famous and an extreme example. I don't think any of us are ever going to do what he did, but if they couldn't get him, I don't think they're going to get any of us for, maybe get a DUI and you reckon hurt somebody or whatever you can get sued of, whatever you can think of. I don't think it's going to be worse than what OJ did. And if they didn't get him, I don't, it's pretty bulletproof, right? So asset protection is a big one. Having your money in real estate is good. Trust, it's all fine and dandy, but like another level of protection, having it in whole life is, pretty litigation proof.
Yeah. So if you go buy a rental property, they could get at whatever you put into that, but they're not going to get the policy itself.
Correct. Yep. But here's the other thing. Maybe you know what's coming, right? If you know what's coming, you know a lawsuit's coming, or shove all your cash, overfund it. Maybe it creates a mech, which I didn't even talk about. So it's a good point for them to bring up is, people ask me how much cash can I put in there? Why are there limits to how much cash? And And what that is, it's called a modified endowment contract. So if we don't exceed a certain threshold, it grows tax-free forever. And it never, you never pay tax, and that's great money. If you borrow from it, which I'll never advise my clients to surrender the policy or cash it out, you'd always borrow from it, therefore it'd always be tax-free. But if we exceed a certain threshold, now it creates a MEC, and now it's taxable. But the alternative might be your assets being lost, and maybe it's worth paying tax on that money. So you'd shove all your cash in your policy. Maybe it creates a MEC, that's okay, but it's all protected, right? So again, it's pretty useful tool. And I like to, when I'm trying to understand it, or when I was early on trying to understand it, I was like, how can I understand this? Well, the wealthy people do it, rich people do it. And if rich people do it, why am I not doing it, right? So it's like, rich people may not be always that bright, but they got smart people around them. And this is one of the few things we can do that rich people do without even, the mansions and the cars and the private jets. That's all rich people shit, right? But we can do this without being that way. We can do a version of this, and that may help us get to that level, right? So rich people do it. That's all I had to know when I got into this thing, to understand it before I was even before I was a client, rather. I understood that rich people did it, so I need to figure it out. And that's what got me to understand it more. Anybody else? How'd I do?
Great.
Good.
Yeah.
I sometimes speed through it because I know it. It's like I need to slow down sometimes, but whatever you guys need me to go over, I can, or hopefully my contact info will be out there somewhere. You guys can reach out to me one-on-one, whatever you want.
If you want to put yours in the chat,
Yeah, sure.
for now, and then we can post it on our website
Yes.
once we put the recording up.
Okay.
Yeah, man, I've seen this being presented multiple times over the years, and you really kind of broke it down
Good.
for my
Well, I
fifth-
used to be, I mean, I don't really get into my history, but the tattoos didn't come from financial life. It was when I was blue collar. So I speak, caveman pretty fluently. And that's what I learned to do, is to just dumb this down as much as possible. And a lot of my clients are very financially illiterate, right? So it kind of helped me be able to learn how to dumb it down, I guess,
Yeah.
And then my Instagram is Anthony.
Yeah, the analogy of whole life is like buying a house, and term is like renting. Is perfect, especially especially since our audience is
For
mostly
the audience, right? Exactly.
real estate.
And even non real estate people usually get that too. So it's kind of handy to use that. And I guess I can go through real quick. Anybody else? I mean, Ashley or Steve or Michael or Bistra, any more questions?
So, how long has this been in practice?
So Penn Mutual has paid a dividend every year since 1847. So it's been around a while. And that's one thing I forgot to touch on, was like the longevity of that. But yeah, I mean, I would say it's safer than banks. Mainly because of how long they've been around, but then also, again, going down like kind of a rabbit hole, wealthy people have their money here. They're not going to let this fail, right? Banks fail because everyone has their money there, but like wealthy people have their money here. They don't fail.
The benefit to family, that's very
It's
important.
huge. Again, I can go on, man. I always forget so many things, but the legacy part of it's so big, right? Like you're gonna die, right? We're all gonna die. So like having something to pass on, no matter how big your empire may or may not get, this is guaranteeing that can continue on forever. And let's be honest, man, like I don't want to save all my retirement money for my kids. I want to enjoy my shit. So I'm gonna have a big policy. I'm gonna burn through my money. I'm gonna spend every dollar I got. I'm gonna be out of gas in my Lambo when I die, right? Like I want to die with nothing, but then have legacy to pass on with my life insurance policy, and and not feel bad, right? So a lot of people again have this big this empire or whatever you want to call it, and they for retirement and they don't want to spend it, and they're so worried about passing on. But if you have a life insurance policy, you can enjoy your retirement a little better too.
Yeah.
Anthony,
Yep.
I have a question, right? The chart that you showed, how accurate will it be, I mean, in future, when we accumulate all those, dividends? I
How,
mean, sometimes it's the mathematical, like I heard that, one of the guys told me that the chart that, insurance guys show, they are not accurate.
okay, I
A
got
lot
you.
of expenses, they won't be, just,
Great.
I mean,
I
it's
one
just like a
another
performance
topic
the broker
yeah,
shows.
no, that's a great question. One topic I forgot to bring up was IULs. And if you're on the internet looking for infinite banking, a lot of times IULs pop up. And that I hate
What's up, guys? I'm sure you're enjoying the podcast. It's fucking awesome. I know. Okay. But let's talk about one of my sponsors, Alpine Moving Company. So we all know that moving sucks. Okay. Stop asking your buddies to fucking move you. It's always a problem. We know that. Be an adult. So use Alpine Moving Company. They know how to get the shit done. They offer residential and commercial moving. Also, they will move you anywhere within North America, anywhere in the lower 48, Canada, Mexico. And they're going to hook you up with 10% off. So discount code MOVE24. Make the right move.
IUL almost more than I hate Dave Ramsey. IULs are kind of trash, and the reasoning is what you just mentioned. They'll show you a chart with these golden numbers and showing you compounding interest forever with never a negative year, and that's impossible. It doesn't happen, and there's no way to mathematically calculate for negative compounding interest or interrupted compounding interest, right? So they're showing you 7% average compounding interest forever. That's a made up number, doesn't exist, right? What we show you is a dividend. That dividend is not going to fluctuate very much, and we're crunching it with the current number. So the current number is 575. That's pretty close to where it's going to be, and they're showing it crunched with really conservative numbers. So in reality, a lot of whole life policies, especially with Penn Mutual and with the overfunding that I do, actually perform better than the illustration, whereas an IUL will never. The day an IUL is written, it's out of date. And they don't really factor or let you guys know about the rising cost of insurance with an IUL. IULs get more expensive as we age, which erodes our cash value, which erodes the reason we're doing this. So the reason IULs even exist is because they rely on the stock market returns for their performance. Any asshole company can do that. Okay, any company can do it. They're using stock market money to make that work. Penn Mutual and the kind of the big five I was referring to, they're using the dividend, the strength of the company to perform this. Not all companies can do that. Very, very rarely can a company do that. So IULs are pushed by everybody. Every company pushes IULs because all they have, they don't have a good whole life product. So to kind of long-winded answer to your question is a lot of illustrations come from a bad IUL. And kind of like if you're asking a mechanic what truck to buy, that's the best person to ask because he's working on them all day, right? Like you see what the mechanics are driving for what car you want to drive. Anybody in my side of the table, none of us have IULs. We all have whole life policies overfunded. So that's kind of multiple answers to only one question that you asked, but let's hopefully got some more information to you guys. The charts are very misleading for IULs. That's where I think you're probably.
So what you are saying is that the illustration. I mean this one is totally different from the IUL, right?
Correct. Absolutely. Yep.
I heard that even the dog, one of the guys, who did that IUL, he had 66,000 lawsuits.
Yeah.
Wow. I mean, I was Googling last year, when somebody wanted me to sell the whole, whole life insurance. That's why, I thought, oh, so it's different from IUL. Okay.
Yep.
That makes sense.
And again, it's hard to completely quantify how bad most whole life products are. Most whole life are not going to perform well. Same with IULs, right? It's a very select few with select companies and even less agents that will design them properly. So when you guys hear all this information about them being bad, like I hate to say it, they're kind of right? It's just find the right agent, find the right company, and then I can talk shit all I want because they're not talking about me at that point,
Okay.
To answer your question?
Yeah.
Kind of rambling. Okay, thank you.
I'm glad you touched on that IUL stuff.
Yeah.
Yeah.
I have many stories that people don't even know, and then they turn 65 or 70 and they go to. It's crazy. It should not be legal. They're that bad.
What does IUL stand for?
Index Universal Life, and what they basically tie that performance to is the stock market. And then what they'll tell you is that, oh, well, you can never go below zero. They're going to basically build a floor in. So maybe your bottom investment can only go to 2%, right? And then, but what they do is then they cap your upside too. Maybe your high side's only 8%, and the company will keep the difference. But what actually happens is, if you look at the numbers, you're better off riding the full wave of the stock market versus capping yourself off. And they forget to tell you conveniently that the cost of insurance goes up every year. So that payment you're paying every month, it's like an inverted mortgage, right? Instead of paying more towards your principal, it's paying more towards insurance as time goes on. And people don't understand that. So it erodes your cash value. But it's sexy because people like the stock market. People like, when you tell them 10% return possibilities versus, I just told you 5.75, right? It's like, oh, I want that. I'll take my chances, and that's what people kind of get sucked up into. But index universal life is not the way to go.
But if it's tied to the stock market, all right, you said that they put a cap on it at, say, roughly 8 to 10%, but we know that like index funds and the S&P 500 can go, 20, 30%
Yep.
in a given year. So
Yep.
they're literally keeping more than twice what they're actually capping. Wow.
Yeah, and their trade-off, what they're telling you and how they're selling you is that, well, it doesn't go below zero. It doesn't go negative 20%, which we know that can happen as well. So it's like, oh, I can ride right here in the sweet spot and feel good about it and get a death benefit. It's like they're acting like it's combining all the good things about everything, and it's really not. So I mean, it's just misleading, most best way I can say it.
Thank you.
Yeah. But again, the reasoning is, and once you understand the reasoning, it makes more sense, is if you have 1,000 agents, 990 of them can sell only IULs, and the other 10 of us can do a whole life product that's worth a shit, right? And then of those 10 of us, maybe only 2 of us will structure them good for you, and and the rest don't. So like, it's such a minority of agents and companies that a whole life product actually works, that they only show you IULs, because in the short term they can be kind of sexy, but mid and long term they're not.
And aren't the commissions a lot higher on IULs?
Yeah, because there's no overfunding, or the money's going towards it's all going towards the product, right? I mean,
I run it across people all the time, say, oh yeah, infinite banking, whole life. I could do that.
Yeah.
Like,
Can you actually, right? It's funny, actually, I don't know if you guys follow football or not, but I went to a networking event, and Austin Eckler was there. Running back was the Chargers, just signed with the Washington Commanders, I believe. And we were talking about it, and he goes, oh yeah, I got an IUL and it's great. And he starts talking about how good it was. And I'm just like, hear me out. And he didn't want to hear it. He didn't want to hear that he NFL player, he's got a guy, he's all set up. And I'm just like, I want to talk to that guy in about 30 years and see how he's feeling about that, See, but some guys just think they do more research, or they think they know what I don't know. That's like me going in a dealership and buying a truck that's everyone knows it's a lemon, and I want the truck no matter what, right? It's like, you kind of got to listen to the experts, that do this. But yeah, definitely talk to people that will die on that hill that IUL is better, but it's easy to show the math that it's not,
So if somebody sets up a policy with you, you're there to kind of help them figure out like how to invest that money, like over time.
Yeah. So like, I'm going to help design. Yeah, I'm going to design it with their, like, I'm going to try to understand what their goals are, right? Yeah. Again, I told you some of my clients don't have real estate goals just yet. They're young, they're in their 20s. I know I want to do something one day, but right now I'm gonna focus on work. But one day it'd be nice to have some money and I can invest in real estate. Great. We're gonna do 50-50 blend, 500 towards insurance, 500 towards overfunding. You're gonna get there pretty quickly, but not right away, right? Some people come to me, hey man, I got like 200 grand laying around. How can I reinvest this the best way to use it immediately? All right, cool. We're gonna overfund it, the big lump sum. And then, hey, by the way, when that time comes, I've got a pretty big network of realtors, lenders, fix and flippers, right? I've got a pretty big network that I can help refer my clients to get them in that game, right? Because some guys are, hey, I know this works. I know real estate's the answer. I have no clue where to start, right? I've already got clients that I showed them how and why we should cash out their 401k, take the small bump. It's smaller than you think it might be, reposition in life insurance. And he's already bought a house in Dallas, Texas. He's already cash flowing. he's way ahead of where his 401k would be, right? So like, that's what I do. It's not just setting up the policy, it's setting it up with your goals in mind. And then what's step two, right? First step, let's get it in place. But then what are we gonna do?
Yeah. That's why you're here talking
Yeah,
to our
yeah.
people.
Yeah, exactly. And I've got other investments that come my way all the time. Like I got a guy hit me up today for, it's 50 grand with 40% payback, 40% interest over 6 months. That's a great way to use your life insurance. You got take it out for 6 months and make 25 grand. That's a great way to use your life insurance. Because what else, if you just took that money out of your savings account or maybe out of a other investment to blow up your other investment, it would be kind of hard to make that work, right? So I come across things all the time. And my goal is just to kind of educate people and steer them without, making the decision for them. But there's a lot of ways we can use this.
Yeah. Beautiful.
I have a question, regarding like whole insurance.
Sure.
Can we use, this whole insurance as a HELOC? Like, we just
Yeah.
we draw some money and invest, and then, we can just use as a credit card, right?
Yep, absolutely. And you pay it back whenever that investment cashes out, or if you just want to make an extra payment towards it, however you want. Yeah. Or not pay it back at all. And just like, hey man, I'm 80 years old. I got $3 million in cash and I'm going to ball out. Fuck it. Like you can do whatever you want to.
There is no limitation, right? In
No
paying, like,
limitation. The problem is you can also use it for really dumb stuff too, right? I tell my clients all the time, you can take this money out and go to Vegas, put it on black and lose it all tomorrow. Okay. I'm not going to tell you to do that, but there's no limitations as to what you take this money out for. There's no documents to sign. It's literally a form you fill out and we wire you the money the next day. That's how you borrow from yourself. There's no application. There's no screening. There's no, is this a good investment? Right. It's just, you need 10 grand to go buy whatever you want, right? So it's however you want to structure it, which is a beauty to most people, but probably can be a downside to some degenerates out there. It happens.
so how will I pay, through the checking account or what?
Yeah, so you're going to pay for this thing monthly or annually or whatever out of your checking account, and then the same account it comes out of will be the account you wire it to. Now you don't have to. For instance, myself personally, I just took a loan against my policy and I wired it directly to my E-Trade account. I can go buy some stocks with it. Wouldn't recommend that. I'm gonna edit that part out of the video, but I did that. Okay. So it can be any bank account that you own. You can wire it back to yourself. So some people have multiple accounts, right? That makes sense. So you can wire it to yourself. You can mail a check to yourself. It's however you want to.
Okay.
Super flexible.
That's why they
As
also
you
call it
mentioned,
on yourself, right?
Yeah.
You're your own bank. You can do whatever you want with it.
Yep. You become your own hard money lender. Like I said, a guy hit me up right before the meeting. Hey, are you interested in a $50,000 investment? Right? Like if I, there's a lot of reasons I'd say yes. I got some other things I'm working on, but that's how a good way to make this money work for yourself.
Yeah.
as you're discussing, payments, I'm here thinking again about my age and how much more this new policy would cost me versus the one that's, currently in effect.
Yep.
The one that's currently in effect is the second of two that I alluded to earlier, and that one I started at 32. I'm
Okay.
still in as good health, if not better health, actually close to 50 than I was at 32.
Sure.
So among the 5 companies that you mentioned, I see from your email address that you're part of Penn Mutual.
Yep.
So are you acting as agent solely for Penn Mutual, or can you act as an agent to get the best price among, say, the 5 companies that you recommended?
Yeah, I can. I'm going to start with Penn for a couple of reasons. They're the best performing when it comes to whole life. So let's say a term policy only, let's say it's $38 to $50, or it's so marginally not worth it. I'm going with Penn all day long. That being said, without even looking, dollar for dollar, Penn will buy more death benefit than anybody else I've seen. Penn is the best. And because it's like the top 5 are so marginally the same when it comes to that, I'm not going to mess around wasting. We're going to go with Penn. If you got declined for whatever reason, I may try another carrier. Or if there's a weird circumstance, or hey man, you can't pass a medical, I'm going to even outsource it beyond Penn in the top 5. There's other companies that we can use, right? So that being said, if you get approved, we're going with Penn. We can certainly shop around, but I've done it, and Penn's just the best bang for the buck. If that makes sense. If you're healthy, that's Penn. If
Thank
you're
you.
not healthy, there's might be a reason we go elsewhere, but that's why I'm with Penn.
Okay, thank you. That, I'm pretty sure it'll be Penn for me also. Thank you.
Yeah, yeah. And also to your point, you mentioned it being more money. So there's two ways we structure policies, right? One is for death benefit and one is for cash. If we're just looking at the cash value, the death benefit, it's not going to cost you any more money, but $1,000 a month, $1,000 a month, right? How much death benefit that buys may be lower because of your age, but the way the cash will grow and the way I structure will be the same. On the term side of things, that might be a little more different where, hey man, I want to have $2 million death benefit. Okay, cool. Well, that may actually cost more money per month, but the whole life side of things doesn't actually, it won't cost you any more money. Your budget is your budget. It's the death benefit that'll be adjusted basically, right? And you're almost 50, you still got, call it 30, 35 years of growth ahead of you as far as your death benefit grows. So it shouldn't, don't let it deter you. It's going to be still, a badass product.
Thank you.
So if the death benefit isn't important, you're just all about the cash. Like say, I don't have kids, wife, I don't
Yep.
care.
Yep.
Can I put $200 in, and then overfund like, 800 or something?
Yeah. And maybe not that much, but a version of that, right? Again, everyone's different. Everyone has different goals. And I talk about that, but yeah, if you're a single dude and you're no plans on kids, or you're like, fuck them kids, whatever they get, we can structure lower death benefit. And the beauty is it's going to grow anyway, right? It can start low. It's still going to grow, but some people are a little more worried about the death benefit. Maybe we'll do closer to 50-50, right? So everyone's different. There are different ways to structure it. We probably can't do 200, 800, but maybe we can do 350 and 550 or 400, 600, right? But certainly weighted more towards cash than insurance. But everyone's different and everyone's health and age is different. So all those are factors.
Mhm. That's why we have you to
That's right.
help us figure it out.
Yeah. Is Ashley still there? She's sleeping? She's been quiet. Steve?
I'm
Steve,
here. I'm making dinner. I'm
Okay.
listening.
all right, cool. Steve,
What
you
do-
got any questions? We lost Steve.
I don't know what he's got going on. He's
Hope
one
he's
of
on
them.
twice though. I like it. Hope we got dual questions.
Yeah.
All right. Well, I mean, if you got no more questions, man, you guys can always hit me up. Some of you
I
already.
just have a question really quick.
Yeah, sure.
Okay, so I am obviously a little bit younger. So my ideal plan would kind of look more like your first two.
Okay.
But then I could kind of like how did you call it? Like when you over invest into it, or what do you call it?
Overfund it. Yeah, overfund it.
Overfund it, yeah. So like as I get a little bit older and more established in my real estate business and stuff like that, I would like to overfund it as much as possible.
Sure.
Like I'll put all my money towards something like that. So at that point, is there where you can change your premium?
A
Or
little
you
bit.
just
If you guys
overfund
have
it?
maybe another 5 minutes, I can show you exactly how I would do that for someone like you.
Okay.
Yeah. Let me show my screen. I always get paranoid what's on my screen. When I click off fucking meeting. Jesus. Can you guys see all right? Is it sharing?
Yeah.
Okay.
Yeah, we can see.
Your Penn Mutual.
All right, cool.
So I think like I could pretty easily do $1,000 a month for premium.
Yeah, but what you're saying basically is over time that should increase, right?
Yeah, like
Okay.
over time, I would want that to be
Yep.
closer to whatever
So-
I mean.
Yeah, how old are you right now?
28.
Okay, so we'll do 29 because it rounds up typically within 6 months, and we'll just okay, we'll do that. So what we'll do is the same thing I showed you before, the 500, 500, but we'll increase the overfunding part. So the base premium will always be 500. And then the paid up additions part is where we can get kind of adjusting, which is kind of cool. So let's say the first year we just do, let's say the first 2 years, we keep it at the 500. But then after that, maybe we do 750 for years 2 through 4.
Oh, cool.
then maybe 1,000, 5 through 7, and then let's see what 2,000 does, if it even lets us from like 8 to max. Okay, so this is probably going to limit me out at a max, and you guys can see what that looks like too. Okay, cool. So it's showing us a mech in year 48. What that basically means is nothing, but it shows you we tried. Like, that's a good thing. We're gonna, basically at year 47, we just have overfunding it. Totally fine. But if you never see a warning of it being a mech, that means they didn't shove any cash in there. That's just a telltale it's not overfunded. So what that would
Okay.
look like is you can see, oh shit, hang on. I made a mistake.
I was gonna say, no, that's not what.
Hang on, hold on. Let's see here. I just got to do one button here. There we go. Okay, there we go. That makes more sense. So 17, right? So now it's saying, hey, you can run this thing the way it's illustrated, but at year 17, you got to back off the overfunding, which is totally fine.
And that's only based on the premium though. So that's not me overfunding the account at all or doing the cash deposit into it.
No, that's doing it the way I illustrated it by showing the extra cash.
Okay.
So
But
basically
just based on the
17
premium though.
Yeah, 17 years in, we have to stop throwing the extra cash at it and just go back to $500 a month, which will
Okay.
feel like no money at all. So now you can see that. Let me get my pen out here.
But say I had like 80 grand to throw towards it.
Which I didn't.
That would be
Yeah, I didn't
faster?
illustrate that in this scenario, but we can absolutely do that. Yeah.
Okay.
And this one I was just showing you, like, increasing your money every year. So like, first couple of years, first year's that, then it goes up, then it goes up, then it's kind of maxed out right here. And in fact, I think I tried doing $2,000 a month. It didn't quite take the full $2,000. It's only going to take a little bit less than that. So, point is, you can increase it with overfunding, and the cool thing is that's all optional. So if we get to a spot where we think, hey, we can do an extra for this year, but then maybe halfway through the year you can't for whatever reason. This part right here is showing you the breakdown. This will always be the same until you pass away. And there's ways we can turn that off too. But this is your PUAs, is paid up additions.
Okay, so that's
This is what increases.
Okay.
Yep. This
So
is
it
what would
is
increase
separate
and be
from the
optional.
premium.
And this is
Okay.
optional, right? So like, let's say you are doing good for 10 years and like, hey man, I'm just hit a rough year. This 15 grand a year doesn't have to be paid. Just
Okay.
this. So another thing, back to the overfunding as to why it's a good thing, is it builds in flexibility right away. Because if you have all of this 12 grand towards your premium, you've got to hit that no matter what, right? This has to be, it's all insurance, you got to hit it. But if it's half and half, you've got flexibility built in right away.
Okay.
So that's one way we can structure a plan based on someone's maybe future growth. I work with a lot of apprentices that, have scheduled raises, contractual raises coming up. So like, they know they're getting more money. In the short term, they're a little strapped. So we build their policy kind of ramping up.
What happens if you can't pay that premium? Is it just boop? It's gone.
Not really. So let's say in the first 2 years, you're probably going to lose your ass, right? But also, if you structure with the overfunding like I've done, you've got instant cash in your policy that you can borrow from to pay your premium if you had to. Okay.
Yeah.
It would maintain the policy. Everything's good. Now the growth would slow down, but it is what it is, right? Better than a surrender in the policy. Let's say after 10 years, you're like, dude, I'm just done for whatever reason. You take the policy, what's called paid up. You'd stop paying for it. And actually I can go back to her policy and show you what that would look like. Everything would kind of slow down, but at the same time, you'd still maintain a death benefit forever. So if I go back in here and I just change that, hey, we're only going to pay this thing for 10, let's say 10 years. We'll do age 4, what's it, age 29, 49. So we just pay it for 10 years. What's going to happen is the death benefit everything will shrink and then continue, can kind of regrow. There's always an option, basically, is what I'm trying to get at. So like in this case, you pay it for 10 years, the death benefit's $255 when you're done. Here's your growth. It's still growing forever, right? And because you're only paying for 10 years, the death benefit wouldn't be what it was. It's going to be smaller. right?
Mm.
So like, it's still something. You don't lose anything. You just have more available than you put into it. It's still a net gain. And then if you just paid for it for 10 years and you passed away in your 80s, there's still a pretty good death benefit,
Mhm.
right? Again, not optimal, but it's not wasted, right? You want to pay, the longer you pay, the better it is. It's just, the longer you pay, the better it is. It's like you're paying off your house.
Cool.
Anybody else? Cool. This has been great, man. Thanks for having me, James, Toby. This is awesome. Happy to do more of
you.
these. Hopefully this recording, we can spread this recording around and, go from there.
Yeah, totally. We can get you the recording. You can chop it up too if you want.
Sweet.
Yep.
All right, we'll talk to you guys later. You guys have all my
Cool.
contact info, hopefully. Reach out to Toby and James and chat later.
Fantastic.
Thank you all. Thank you
All right.
very much. Really
Thanks, guys.
appreciate it.
Appreciate you guys. Thanks.
Thank you.